Welcome to The Explainer. Today we're tackling something that catches a lot of physicians completely off guard, and that's the absolute reality of locum tenens compensation. Specifically, we're zooming in on the harsh reality of 1099 taxes for 2026. You know, when a doctor switches from a comfy W-2 employed gig over to 1099 locum tenens work, something happens that frankly, nobody at the staffing agency really warns you about. Your tax bill goes up, and I mean it goes up dramatically. Not because you're suddenly earning millions more, but simply because of how the IRS classifies that income. But, as we'll see today, that exact same classification also unlocks some pretty incredible financial tools if you actually know how to use them. Because here's the kicker, 15.3%. That right there is the self-employment tax rate. See, as a W-2 employee, you're paying 7.65% in FICA taxes, and your employer just quietly pays the other half behind the scenes. But as a 1099 independent locum physician, you pay both sides. You bear that entire 15.3% burden. To put that into perspective, let's say you have a $300,000 net locum income. You are looking at over $28,000 in self-employment tax alone, and that's before your regular federal income tax bracket even kicks in. It's literally a massive bite straight out of your take-home pay.
But hey, don't panic, because we have a roadmap to get that money back. Today we're covering 1. The 1099 tax burden. 2. Operations and travel deductions. 3. Benefits and professional fees. 4. The massive 23% QBI deduction. And 5. Common tax deduction mistakes. All right, let's get into Section 1, the 1099 tax burden, and exactly why locum taxes differ so much. Think about it like this. When you're a W-2 employee, your employer is basically your financial shield. They absorb an enormous layer of costs on your behalf, paying half your Social Security and Medicare, funding your malpractice, absorbing those pricey licensing fees. But as a 1099 locum, every single one of those costs comes straight out of your gross revenue. You bear the full brunt. However, the flip side is that you now gain access to a whole world of exclusive write-offs that W-2 employees simply cannot touch.
Which naturally leads us to the most empowering question you can possibly ask. What can 1099 physicians actually deduct? Because once you understand the IRS rules for 2026, you completely shift from financial anxiety to strategic empowerment. Used correctly, these deductions can offset a huge portion of that self-employment tax burden we just talked about.
Okay, let's dive into this. Section 2, Operations and Travel Deductions. These are your primary write-offs.
First up, the home office. Honestly, this one is heavily underused. If you have a space that is used regularly and exclusively for business, like a dedicated den where you review charts or handle all your credentialing, it qualifies. Now, catching up on charts at the kitchen table, not going to cut it, but a dedicated space absolutely will. The IRS simplified method allows a flat $5 per square foot up to 300 square feet, which gets you an easy $1,500. But the regular method, where you calculate a percentage of actual expenses like mortgage interest and utilities, usually wins out for physicians. You'll definitely want to run the numbers on both. Next is travel and lodging. Locum work is travel work, right? So flights, rental cars, and hotels are fully deductible as long as the assignment is temporary and it's away from your tax home. And finally, malpractice. A lot of agencies provide basic claims-made coverage, but the tail coverage, the part that protects you after the assignment actually ends, often falls squarely on your shoulders. That premium can run tens of thousands of dollars for high-risk specialties, and every single penny of it is a deductible business expense. Looking specifically at that travel piece for a second, 72.5 cents per mile. That is the exact 2026 IRS business mileage rate. If you're driving to your assignments, this adds up incredibly fast. Let's say you have a 200-mile round trip, and you log that once a week over 40 weeks. That's 8,000 miles. At 72.5 cents a mile, you are looking at $5,800 in deductions just for your commute to that temporary assignment. It's like finding free money, but you've got to keep a meticulous mileage log because the IRS definitely expects clear documentation for this one.
Moving right along to Section 3, Benefits and Professional Fees. This is all about sheltering your income. Here are the next 4 primary write-offs in your toolkit. First, licensing and CME. State medical licenses are obviously required if you're bouncing across multiple states, and every single one of those fees is deductible. Your specialty board renewals, DEA registration, interstate medical licensure compact fees, all deductible. Oh, and those CME conferences for your specialty? Also write-offs. Second is retirement. You can contribute to high-yield accounts like a solo 401k or a SEP IRA. Just to give you an idea, a physician maxing out a solo 401k can potentially shelter over $70,000 from federal income taxes. It's huge. Third is health insurance, which we're going to look at closer in just a second. And fourth, professional services. The actual cost of running your business is deductible. This includes your CPA fees, subscriptions to clinical tools, and critically, attorney fees for contract review. Even though you don't typically pay a recruiter directly out of pocket, paying a legal professional to review the contract that recruiter hands you is absolutely a necessary, fully deductible business expense.
Now, I really want to pause on health insurance for a minute because this is huge. Locum physicians obviously don't receive employer-sponsored health insurance. You have to go out and buy it yourself. But unlike W-2 employees, paying for your own health insurance actually lowers your taxable income dollar for dollar. The self-employed health insurance deduction allows you to deduct 100% of the premiums paid for yourself, your spouse, and your dependents directly from your gross income. This isn't just some standard itemized deduction, it directly reduces your adjusted gross income, provided, of course, that you aren't eligible for a spouse's employer plan.
So the crucial point is right here in Section 4, the 23% QBI deduction, the biggest deduction of the bunch.
QBI stands for Qualified Business Income, and for 2026, the entire landscape shifted because of something called the OBBBA, the One Big Beautiful Budget Act, Public Law 119-21. Now, purely as a legal mechanism affecting the tax code, what this legislation actually did was make pass-through business deductions permanent. Practically speaking, it means that eligible self-employed physicians now have a totally stable, non-expiring mechanism to drastically reduce their taxable income.
And here is the staggering number tied to that legislation, 23%. You can literally deduct 23% of your qualified business income right off your taxable income. Let's do some quick math. If you've got $350,000 in gross locum income and $60,000 in business deductions, your net QBI is $290,000. Well, a 23% deduction on that is $66,700. This single deduction can save a physician in the 37% tax bracket over $24,000 in federal taxes. No joke. Now, there are income thresholds and phase-outs involved, especially for specified service trades like medicine, so a CPA who actually specializes in 1099 healthcare professionals is absolutely mandatory here. But man, the savings potential is just massive.
All right, wrapping things up with Section 5, Common Tax Deduction Mistakes, how to avoid that dreaded IRS scrutiny. So here are the common errors that will absolutely get you flagged. First, personal meals. Look, you cannot write off your lunch just because you happen to be eating it at the hospital. It has to meet very strict business meal requirements. Second, regular commuting. Driving from your home to a regular non-temporary work location, not deductible. That awesome 72.5 cents a mile we talked about only applies to temporary travel away from your tax home. Third, dual-use spaces. Remember that home office deduction? The exclusive use requirement is incredibly strict. If your home office occasionally doubles as a guest bedroom for your in-laws, it does not qualify. The golden rule here is simple. Every deduction must be ordinary and necessary for your business, and you absolutely must have the documentation to prove it. And that brings us to our final takeaway. Yes, 1099 income definitely carries a heavier tax burden up front, but it provides a phenomenal toolkit to offset it if you're smart about it. So the question I want to leave you with today is this. Knowing what you know now, how will you structure your 2026 contracts to optimize your true take-home pay? Because understanding these deductions isn't just about surviving tax time, it's about how you negotiate your placements right now. Talk to your CPA, run your own personal numbers, and use this knowledge to truly take control of your financial future. Thank you so much for joining me for this explainer, and we will see you next time.